Taher Badshah, good morning. Thank you for joining us. I will ask you to speculate not in the market, not in the stocks, but about what Reserve Bank of India should announce today. Because the Reserve Bank of India or the RBI governor, the address will start in about 40 minutes.
Well, it's always hard to speculate on what the regulatory agencies will do, but we all know that we require something which is a little more than what has been announced up until recently. And I think more targeted measures and perhaps, if it is possible, direct intervention within certain sectors will be clearly something which will be welcome. I think this was supposed to probably have happened in the last round itself. We can't wait a lot more on this. I think this should have probably been done yesterday. But I think it's important to indicate that stress and relief for some of these important leverage sectors in particular, as you rightly mentioned earlier, maybe a little while ago when I was listening to you about sectors like NBFCs, maybe even real estate for that matter, perhaps the large employers, MSMEs, as well as tourism, airlines, maybe for that matter. These are industries which are going to be significantly impacted, and any kind of direct intervention probably will be helpful. I think if that is not possible, then I think that is where the burden will have to be probably taken by the government. And if that leads to higher fiscal, then I think that is when the RBI has to kind of monetize that. So I think that might be the other way to handle this problem. I think we will see a lot more of some of the earlier measures itself, maybe not a repo rate cut, but maybe some more liquidity measures, extension of the TLTRO program. I think the magnitude is relatively more important. I think the RBI has to kind of communicate that it is there solidly behind the current environment of the economy as well as the market. So walking the talk is something which is probably going to be a lot more relevant this time around.
Taher, the concerns which currently private banks have about retail delinquency going higher, retail franchises could slow down, there would be both a drop in demand and B, a huge uptick in NPAs, which frankly have not happened for private banks. Are those concerns real or markets fear are misplaced?
Well, not entirely misplaced either, but we have at least some things to probably cushion the impact. I think when we look at our situation from a wider standpoint, we know that a large number of our cases happen to emanate and probably are coming out of the urban centers. 65% of the cases are probably coming out of 3 or 4 states. There are large swaths of India which are relatively unscathed. And some parts of tier 2 and tier 3 locations as well are relatively untouched. So in a way, I think if we can, gradually ease the lockdown and restore economic activity in due course after May 3rd, then I think we will be able to contain the problem even with respect to delinquencies. But obviously, from the standpoint of making sure that the crisis or the fear factor in the banking and financial services space does not set in, we can't be relaxed about this matter. We have to take the necessary steps nonetheless, and yet continue to hope that India's problem will be relatively more contained. So I think it is not something which is entirely easy. It is probably going to be a little difficult for the banking system. So preventive measures will be clearly required.
Are you a bit surprised, Taher, that even though global markets have stabilized, Dow is out of the danger zone, emerging markets are looking okay, FIs they continue to sell, and I'm surprised by Taher because on the medical front, we've got, it's relatively easy. On the crude front, there is good news. On the earnings front, because we have a large middle class, the consumption wheel has slowed down, but it will come back. So if India is in a better spot on a relative basis and on an absolute basis in comparison to the world, why are exactly FIs selling?
So I think at least the good part is that the intensity of the selling has clearly subsided. I mean, we have not turned to positive flows as yet, I agree, but what we saw, nearly about $10 billion flow out of equity markets on the FIIs, has moderated down at least in the first 15 days of April by a meaningful amount. That is maybe, if at all, some indication of the stress conditions in the other parts of the world, particularly the US, also moderating. Not as much on account of the control on the virus, but because of their monetary and fiscal policies. So I think it's a matter of time. I think right now the opportunities in some of their own regions. For example, the US markets have also kind of meaningfully corrected, and and there is in the meanwhile also some pressure on emerging market currencies. So I think there will be a bit of a wait out situation. They've just gone out. A lot of money has flown out in a very short period of time, just a month ago. So it's going to take a while to gradually come back. But I think that what we should probably look forward to is first the selling to subside, and then gradually those flows converting into positive numbers. And I think that at least has started to happen over the last couple of weeks.
Okay. Taher, where are you seeing opportunity, given all that's going on currently? We've been tracking, of course, the leadership that the pharma stocks have taken in the markets. Would it be pharma? Would it be something else, where you see an opportunity in terms of valuations, multiples, and in terms of a bounce back once the recovery kicks in?
So, well, in the last month or so, the situation was of maximum fear and anxiety, and therefore, to that extent, some of the more defensive sectors and safe havens, including things which are of daily usage and FMCG types, and pharma obviously had its good round of performance. I think there are a lot of laggards in the market. Apart from that, the whole of the banking and financial services space, as we know, has not really participated, and for the right reasons too. So, some of the other high beta sectors, or probably those which are a lot more associated with consumer spending, have also not kind of participated even in this rally of nearly about 20 odd% from the bottom. So I think in the next round, I would think that at least from a very near term perspective, if everything has to kind of level off and come back to that same level of equilibrium, I think there is a lot of beaten down value which appears to be there in some of these areas like banking and financials, probably even industrials for that matter to some extent, a good a number of areas within the consumer space, non-FMCG. So I think those probably have a good room to probably say, let's say, catch up with some of the outperformers. After which I think we'll have to kind of rejudge as to where are we headed in terms of the lifting of the lockdown, restart of the economic activity, what is going to come back, what is not going to come back, and what is going to probably take a lot more longer in order to revive. How are consumer sentiments likely to change, consumer behavior likely to change, and then take it forward from there on. So in the first round, I would think some of the laggard sectors, the so-called high beta, and those who have not participated have a little more room to perform. And maybe I think policy action, as is expected today and over the next few days, both on the fiscal and the monetary side, should drive that performance.
Okay, so there's a lot actually that you're looking at currently, Taher, which is always heartening to see. Since we're counting down to TCS, I mean, I also just want to get a sense from you on IT. You may not want to comment specifically on TCS, but we've been hearing commentary, Wipro earlier in the week, TCS today. We're just watching out for the management in a couple of moments actually. Where do you feel IT is positioned amidst all of this, particularly given the mix of offshore, onshore?
So, we've seen a couple of results, still not indicative entirely of the kind of landscape which the IT industry is probably confronted with. But the good part is that, and March quarter probably may not be necessarily entirely indicative because, we saw the lockdown impact perhaps just in the last couple of weeks of that quarter. So, but it's from both of these, at least the ones which have kind of announced the results, it looks like the landscape has not really been significantly disturbed as yet. There is from a stock or the sector perspective, I think many of these stocks obviously are in the value zone. Uh, they have been that way for a fairly long period of time now, even before the virus-related issue. I think they've got maybe a tad more cheaper, and I think they're good defensives at one level. They're good, slow compounders, if I were to call them. And at least there you have the confidence and comfort that the balance sheets are relatively secure. Many of these are very, very cash-rich companies, and have the ability to undertake maybe buybacks and dividend payouts and so on. So I think from that standpoint, they look to be in an interesting space. They may not necessarily, provide you that element of strong beta. It also depends upon how quickly the US restores back to normalcy, and US as well as probably Europe to some extent. So that is something that we need to have an eye on. But I think this is a sector where even we are relatively well positioned. So it's a good play to be in from the perspective of provided you keep your return expectations reasonably modest.
Okay, fair enough. So keep those return expectations modest. Taher, what about auto? Where do you stand on that? We've just had a series of conversations with automakers who are sounding, while of course business has ground to a standstill right now, but they're still sounding relatively confident about the demand revival. And that's interesting. You just touched upon consumer behavior as well. It's uncertain, but there are those that are still sounding fairly optimistic about it coming back to normal.
So I probably missed you a little bit in between. I thought you referred to autos as a segment. Is that correct?
Yes.
Yeah. All right. Okay. So I think this was one of the sectors which had its own set of challenges even before the virus set in with regard to the changeovers in fuel norms and the related problems associated with it, and some of the other behavioral challenges which were with respect to ownership of vehicles and so on. And also obviously the challenge on the electric vehicle front from a more longer term standpoint. So I think this is probably going to be a space which is going to be a little bit of a slow burn or a slow recovery even when things normalize. I think within that maybe there might be some pockets of autos which perhaps might have a better chance of recovery. So maybe I would think two-wheelers might come back a little faster than cars, so or passenger vehicles for that matter. I think from an affordability perspective, low ticket size, maybe even from a consumer behavior change post-COVID, perhaps two-wheelers stand to probably have a slightly better edge compared to passenger cars, which is probably a little more high-end discretionary in my view. So I think some of the rural-oriented products such as tractors and agri-machinery, etc., is probably obviously going to fare better and relatively unaffected. So you'll have to slice and dice a good part of the auto space within the overall sector as such.
Taher, good to speak with you this morning, and I especially take away, what you said in terms of quite a wide basket from certain consumer names to industrials. So really keeping it quite open at the moment. Enough opportunity that you're spotting there.